Hello, everyone, and thank you for attending this presentation of position sizing, part of our 7 Secrets of Money Management course. Thanks for taking time out of your day here to come and join me present this webinar. My name is Steven Primo, and I am the president and founder of Specialist Trading. And first and foremost, for those of you who are new to my presentations, we are an educational company. We're all about teaching you how to spot signals and how to manage your money so that you can really empower yourself. Opinion that too many traders are losing in the markets, whether you're trading the Forex markets, whether you're trading stocks or the E-mini, because you're not empowering yourself. You're relying on outside sources to get your information, either some trading guru or some news event or some indicators. So we try to teach you all the things that I've accumulated in my 37 years of trading so that you can really just begin to trust yourself and rely on your own signals. To give you a little bit of background about myself, I've been trading for 37 years. My career basically started on the floor of the Pacific Stock Exchange. I was on the trading floor for a total of 16 years, and 9 of those years I was a specialist for Donaldson, Lufkin, and Jenrette. That's where we get the name Specialist Trading. And for those of you who aren't familiar with what a specialist is, if you just look at those old pictures of people trading on the floor with all the paper on the floor and people making hand signals, the specialists were the people behind those large booths where if you wanted to buy or sell a certain equity, you had to go to the person who specialized in that stock. That's where we get the name specialist. I stayed on the floor to the mid-90s, and I left the floor in the mid-90s to manage money and also to trade my own account. And I was also an educator and director of education for a number of websites. But around 6 or 7 years ago, I started Specialist Trading, where I only teach what I personally use in my own trading. So I teach and mentor my students everything that I personally use. Now, before we begin, we're required to show you this. So please take a moment to view our disclaimer. I'm going to show you some performance results with a great technique. This is one of our secrets in our 7 Secrets of Money Management course. But please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. As I stated, we are required to show you this. So as you're taking a moment to view our disclaimer, I'd also like to mention to those of you who are new to my webinars, I love to take questions, but I like to take them at the very end. I know some presenters like to kind of keep an open dialogue while the webinar is unfolding. I'm a little bit different. It's more like a classroom. So when we get to the end of the presentation, please feel free to ask any questions, but I will not really answer anything until we get to the end. Okay, so if you can't remember them, write them down or try to just hold on to your questions, and I promise I'll get to them at the very end. I'll also leave you with an email address as well as a phone number if you'd like to ask us a question. That way you can do it simply by contacting us, okay? Now, one last thing before we begin, I also want to invite all of you to follow us on Twitter. Here's our handle, @Specialist Trading, abbreviated SPCLST. TRADG. We give a number of different insights and free information on our Twitter site. And also, if you go in there right now, you'll see that just a day or so ago, we issued all of our members a buy signal in the Canadian dollar. So right now, we're up at roughly about 50 pips in that, all of our members who took the signal. So there's a lot of great free information. We also tell you about different presentations. We're going to have webinars and seminars and things of that nature. So I invite you to follow us at SPCLST TRADG. All right, so let's first of all start about what we learned on the trading floor, okay? Remember, I was on the trading floor for a total of 16 years, and contrary to what a lot of people may think, I really had a difficult time when I first started trading. In fact, I really couldn't make a dime. It was very difficult for me to get on track, and I know a lot of you are probably experiencing the same thing. As I stated at the beginning of this presentation, what happens most of all is that we rely on outside sources to tell us what or what not to do, and we kind of give our power away. So what I learned on the trading floor from my mentors was to rely on things that I had studied and my mentors had taught me, and then to trust that and take away the guesswork. So many times we're guessing. We're looking at a news event and saying, well, I guess that's pretty positive, or someone will look at the same event and say, well, no, I think that's negative. And someone will look at an indicator or listen to a trading guru and says, well, I guess he's good because he's got so many people following him, so I guess I should do what he does. So there's a lot of guesswork and a lot of subjectivity involved. And my mentors taught me to get rid of all of that and to just follow a solid framework or solid plan that I had studied and was working over time, and just to stick with that. So money management is all about that. What they taught me is that money management should be non-subjective, just as I just stated. You should take the guesswork out of any type of money management. In other words, you shouldn't guess where you're going to place your stop. You shouldn't guess about position sizing, which we'll talk about today. It should be consistent as well. So in other words, we're not going to say that if you provide yourself with money management, you'll never get stopped out, you'll never have a loss. And then lastly, it should be as simple as possible. Okay, you should keep it simple so that you can get on that road to consistency. All right, you want to be able to be consistent with your trading so that you can have this 2-step forward, 1-step back approach. And we feel the best way to do that is by keeping your trading and your money management as simple as possible. And then lastly, and most importantly, my mentors taught me that money management should make you a part of the process. As I stated, too many people, are not empowered. They give away their trading power. They rely on some type of chat room or trading room or some trading guru to tell them what to do. You should use this as education, but then you should formalize your own plan. Remember, we stated at the beginning of this presentation, we are an educational company. We want to empower you with the education that I've accumulated in 37 years. Ultimately, we want to make you a part of the process, so you don't have to rely on anything else. All right, so we're going to talk about one of the secrets in our 7 Secrets of Money Management course, and we're going to really give away all the rules and show you exactly how to trade using money management secret number 3. All right, and what exactly is that secret? Well, you should never use discretion when deciding your position size. It is absolutely the worst thing in the world you can do. But I would say that the majority of all traders use discretion when they're deciding how much to trade. They're either going to say, well, my account is too small, I'll only trade 1 lot. Or else they'll say, I woke up feeling really lucky today. I'm going to really bet the farm tonight, and I think I'm going to do really well. I feel great about it. Or maybe they said, well, you know what, I've been on a lucky streak. I'm getting a little bit frightened that it's going to end very soon, so I'll scale down, and instead of trading, 2 or 3 lots, I'll trade 1 contract at the most. So it's all discretionary. There's no real plan, no rhyme or reason. It's really motivated by your emotions and your feelings. Let's take this for example. Here's an older chart in the Swiss franc, all right, and this was an actual signal that was generated and given to our members. It was a short here, so this was our entry point to go short. And as you can see, the trade worked out very well. So we would have made some nice money on this. But when you use discretion, when you make it too subjective, how many contracts or lots should you be trading? Would you be only trading 1, 2, or 3? All right. So many times you'll have a really nice trading plan, but you're not getting up to that level of consistency because you're out of sync with the number of contracts or lots or share size you should be trading. All right. So this introduces our RPS method. This is usually reserved for the members of our money management course, but we're going to share this with you in its entirety for figuring out how to come up with the exact number of contracts or lots you should be trading for the Forex market. This is a simple mathematical formula that automatically decides how many shares or lots to trade. See, remember we said we want to take away the discretion, we want to take away the subjectivity, and make you empowered with the decision-making process. So if you use this method, it will automatically decide for you, depending on the calculation and all of the variables that you input into this. Now, let me just say this right off the bat. I know a lot of people may say, well, Steve, you said to keep it simple, mathematical formula. This is getting a little complicated. How can I, in the heat of the moment of trading, come up with this mathematical formula every time? Trust me, it may seem a little wordy as I explain it to you right now. You may want to write this down. But after a while, after some good practice, it'll be extremely simple. You can calculate this in a matter of seconds after a little practice, okay? All right, so here's what we want to do first of all. We want to calculate risk with our percentage of capital. This is probably the most important thing. So what we have to do is we must start with an adequate amount of capital. This is another reason why traders lose. They're either under or overcapitalized because they're just as dangerous. Overcapitalized will give you a false sense of security thinking that you can bet the farm. And undercapitalized will not give you enough to be able to actually trade. So what you want to do is keep these benchmarks. Now remember, these are not in any way something I'm saying that you have to have, but these are just benchmarks. In other words, if you're going to be trading Forex markets and the large contracts or the large lots, you should have, in my opinion, anywhere from 15 to 25,000 to hold positions overnight. Okay? Because you're going to be holding positions overnight. If you're going to be day trading and not holding positions overnight or getting in and out very quickly, maybe, 10 or 15,000 would suffice. Now, if you're going to be trading the mini lots, which are, substantially much less expensive, well, then you can start out with anywhere from 5 to 10 or 15,000, okay? So it all depends on what market you're trading, and it all depends on what style you're trading. Now we want to calculate the percentage of risk per trade. In other words, this means per trade, how much are we going to risk? And we don't mean risk on the actual trade. We mean of our capital. So let's say if we have a $10,000 trading account, we're trading the mini account. All right, we're only going to risk a benchmark of 2%, which comes out to $200 per trade. All right, so this is our benchmark. Now, I know some traders, myself included, usually only risk 1%. Some traders, some hedge fund managers risk half of 1%. Now, we want to keep this benchmark at 2% because this will give you enough time if you go into a series of losing trades, at least you won't lose everything. But what most people do is they'll risk maybe 5, even 10% of their entire account. So if you have a $10,000 account, some people may be risking $1,000, sometimes even up to $2,000 per trade. Well, you have 5 losing trades, you're out. You've blown your whole capital. So we want to keep it to 2%, all right? Especially if you're just beginning. Keep it to 2, possibly even 1%. Now, if you're extremely conservative, you'll want to include slippage or the spread in that. In other words, the number of pips you're on your spread on average. Say it's 3 to 5 pips, something like that. So you want to include that as well as your commission, if you'd like to as well. So these are all things you have to take into account prior to actually even trading. Remember, you must have an adequate amount of capital. You must only risk anywhere from 1 to 2% per trade, and that's 2% of your capital. And then you might want to take the slippage or the spread or even the commission into that account as well. All right, so let's start out with the RPS method. You may want to write this down. I'm not sure if FX Street is recording this. They're usually very good of later posting these on YouTube as well. But if you want this right now, you can write this down. Remember, it may be a little wordy in the beginning. It may be a little complicated to you. But don't worry, after some practice, this will be extremely easy to use. I can usually calculate this in a matter of seconds prior to a trade. All right, here's the formula now, the RPS method formula. First thing we want to do, rule number 1, is we want to determine the 2% risk amount of your capital. Remember, this is the benchmark. It could be 1%. It could be 1.5%. Just make sure that you really don't want to risk more than 2% of your amount of capital. So if you have $100,000 to work with, well, you're only going to risk $2,000 per trade at the most. If you have $10,000 to work with, you're only going to be risking $200 per trade. Okay. Next, you want to decide your stop placement. This could be a recent high or recent low. In our 7 Secrets of Money Management course, we give you roughly 5 to 7 different stop placement levels. So you want to decide which one that you're going to be using on this particular trade. Now, rule number 3, let's say you're stopped out. Let's say the trade does not work out in your favor. What would be the total dollar amount that you lost per contract or per lot? Not the number of pips you lost, but the total dollar amount. In other words, how many dollars that transferred over onto. All right? So, rule number 4 is now that we know our 2% of whatever we're risking, which is the dollar amount, we're going to divide our 2% dollar risk amount by your total stopped out dollar amount. In other words, whatever 2% of our account is, let's say we got stopped out on this. Well, we want to divide that, okay, by the total dollar loss on our amount. And then this will give us a number. We're going to round off to the nearest number for our proper position size. All right? That's how we come up with the formula. Once again, I know you may say, boy, this is a little bit complicated. I don't really understand this. I'm going to show you a lot of examples now. I'm going to break it down into a formula so that you can really easily understand it. All right, here is the RPS position sizing formula. R equals 2% risk amount of your capital. This is in dollar form, okay? This is a simple way to copy this down. So R will equal 2% risk amount of your capital. All right, so you have to figure out exactly how much capital you have to work with, and you're only going to risk 2% of that and put that in a dollar amount. P equals the pip dollar loss if you're stopped out. So if you're stopped out and you lose 50 pips, what does that transfer over into dollars? Okay? Now we simply divide R by P, and this gives us S, or the size or number of lots to trade. See how simple that is? RPS method. I'll give you a second to write that down if you'd like. Remember, if you have any questions, just hold them off to the very end, and I promise I'll go over everything at the very end, just so that we don't lose momentum. But it's very simple. R divided by P equals S. R equals 2% of our risk amount. P equals the pip dollar loss if we're stopped out. So we simply divide R by P, and this gives us S, or the size or the number of lots to trade. All right, so let's look at a theoretical example here. Trust me, I'm terrible at math right off the top, so we're going to take a large number here just to make it simple, all right? I trust most people don't have a $100,000 trading account. We're just doing this to make it simple. But let's say we had a $100,000 account to trade with, all right? So R equals 2% of that. And what is 2% of 100,000? That's 2,000. Okay, so R equals 2,000. Now we have to come up with P. P equals the pip dollar loss if we're stopped out. Now, in order to have this, we need to have a stop placement already in effect. So where's our stop going to be? Well, in this particular hypothetical example, our stop would be 100 pips. All right, so if we lost 100 pips, what does that transfer over onto dollars? That transfers over onto $1,000. Okay, so P equals $1,000. And then lastly, S. S equals the size or number of lots to trade. We simply divide R by P, which gives us S. So R equals 2,000. P equals 1,000. We divide those, and that comes up with 2. So we can trade with 2 lots or 2 contracts. That's how simple it is. Now, I know we use a hypothetical $100,000 account, but we just did that to make it really simple. Let's go down and use another hypothetical $20,000 account. This brings it more down to earth, okay? So we have a $20,000 trading account. We're going to trade the large Forex lots. R equals 2% of that $20,000. All right. So what's 2% of 20,000? It's 400. So that means that's all we're going to risk on this particular trade. All right. What does P equals? P equals pip dollar loss if we're stopped out. So what are we, where are we placing our stop? Well, once again, we're going to risk 100 pips. That comes out to $1,000. So P equals now 1,000. So we're going to divide R by P. We're going to divide $400 by $1,000. That gives us S. And that will be a negative number, all right, because 1,000 does not transfer or divide into 400. So this tells us with this particular setup where we want to enter, where we be stopped out, how much our trading account size is, how much we're risking, we can't take the trade. Do you see how this is automatically deciding for us? And we don't have to use any guesswork. We don't have to say, well, I'm going to take this, and what if you lost $1,000 or so, or you lost too much of a size of your account? So this is keeping us in line. So this is a great example of how the RPS method will actually keep you out of a trade. All right, let's look at these older examples, mainly just for educational purposes so that you can fully understand this. This is an older example of the Eurodollar. This is an actual buy signal. But let's just say we had a $100,000 account. All right? All right, so we wanted to calculate and see what R is. R is 2% of that, which equals 2,000. So we know on this particular trade, we can risk 2% or $2,000 of our account. And our entry point will be right here. All right, and in order to come up with P, we have to decide where our stop placement is. So this is one of our stop placements right below the opening of that particular setup bar day. All right, so this is where our stop would be, and we have to calculate. If we entered at the entry point and got stopped out, how many pips would we lose, and what would that transfer over into dollars? Well, that comes out to roughly 100 pips. So for trading the Eurodollar, 100 pips equals $1,000. So R equals 2,000. P equals 1,000. Now, in order to come up with S, or the size, we simply divide R by P, which gives us 2. So we can trade this with 2 lots. Before we even entered into the trade, we know we can trade with a $100,000 account with these parameters of entry and stop placement. We can have 2 contracts or 2 lots. And as we see, you would have entered the next day, and in 4 or 5 days, you would have made roughly a couple of hundred pips. That would have come out to roughly about $4,000 in this particular trade. It's trading 2 lots. Not a bad trade, right? You would have made 4% in roughly about 4 days by only risking 2%. What if we use a different stop? Okay, let's see how the RPS method can alter this simply by using a different stop. What if you didn't use this stop? What if you would like to use another stop? Well, we're going to use the same hypothetical $100,000 trading account. R equals 2% of that, which is $2,000. So R equals 2,000. Now we have to come up with P. Now, if our entry is right here, where's our stop placement going to be? Well, in this particular example, you want to give yourself a little bit more room, so you place your stop right here. All right? Nothing wrong with that, but we have to calculate how many pips that is, and that comes out to 200 pips. All right? So if we got stopped out, we would lose 200 pips. Now, what does that transfer over into dollars? 200 pips trading the euro dollar would come out to $2,000. So if we want to find out how many lots or what our size is going to be, we simply divide R by P. We divide 2,000 by 2,000, and that gives us 1. So we can only trade with one contract, with one lot. Why? Because we've given ourselves a little bit more room here, and we've taken on a little bit more risk. So the RPS method is deciding for us, since we've taken on more risk, since our stop is a little bit lower, we're only going to be trading with one lot in order to fulfill all the requirements of the RPS method. And so instead of making $4,000, that's okay. We still would have made roughly $2,000 here in the next 4 days with only trading one lot, but because we gave ourselves a little bit more room to work with. We had a little bit more risk in the trade. All right, what if we use only 1% of our trading account? Remember, we said 2% is the benchmark. We shouldn't really go over that. What if we're trading with less than that? All right, so let's see. We still have the same hypothetical $100,000 trading account. We want to come up now with R, which is only going to equal 1%. So 1% of 100,000 obviously is only $1,000. So R equals $1,000. Now we have to add some structure. We have to know where we're going to enter, which is at the same place right here. And we have to know where our stop is going to be, which is right down here where we had in the previous example. So we're going to risk 200 pips, right? 200 pips in the euro dollar would come out to $2,000. So R divided by P, 1,000 divided by 2,000, gives you a negative number. So we couldn't trade this using a 1% benchmark. You see how the RPS method decided for it. See, this is the beauty of this method in that it's not going to give you the same answers each and every time. It's all going to change due to your parameters. As your account increases, it will change. As your percentage of how much you're risking to, or you're deciding to risk for your account will change. Okay? As your stop placement changes, it will change. So it's using all these money management parameters to keep you in line. Now, this doesn't mean just because, all right, you're not going to be able to trade on this to say, well, okay, well, I'll increase my percentage up to 5%, so that way I can take this trade. That's not what this is used for. Remember, we want to keep our standard benchmark at 2% of our account. So, if you wanted to, you could say, well, this trade doesn't work with all these parameters here with my entry and stop placement, using only 1%. I can possibly go up to 1.5%, or maybe it wouldn't work there, so I'll go up to 2%. But that's it. You cannot go any higher than 2%. All right, so let's review secret number 3. Remember, this is part of our money management course. This formula is usually only reserved for the members of that course, but we're sharing with you in its entirety today. So you have all the rules for trading the Forex now with the RPS method. Remember, though, whenever you're using this calculation, make sure your trading is adequately capitalized. In other words, it won't really matter if you're saying, well, I'm going to trade this and I only have $1,000 to trade with, the mini lots with. That's not enough. Because if you use 2% of that, of $1,000, 2% of 1,000 comes out to roughly $20. And I don't think you can, with any standard stop placement, you can have an actual trade only risking $20. So you've got to make sure you're adequately capitalized. If you're trading the mini lots, we'd say anywhere from 5 to 10, 15,000 would be more ideal. If you're trading the large lots, the large Forex currency pairs, well then you should be from anywhere from 15 to 25,000 because you may be holding positions overnight. Okay. On average, your benchmark to risk of your account per trade should be 2%. Remember, this will increase and decrease as your account either grows or decreases because of some type of drawdown. So if you're starting out with a $10,000 account and you start to go up to 15, you go up to 20,000, you're doing very well. Well, your 2% is going to increase. You see that? As you possibly start to lose, let's say you go into a drawdown, well, your 2% of 10,000 would be more than 2% of, say, if you go all the way down to 7,000. So this is always going to change, but it's always best to use 2% as your benchmark. You can trade using only 1% or even 0.5% of your account if you'd like. To review, the RPS method is a simple mathematical formula that must be used prior to every trade. All right? You have to use this prior. I calculate this in my head because it's that simple. I've been doing it for so many years. But in the beginning, you'll have to, take you a while. If you're holding a position overnight, well, that's okay. It'll be very easy. You'll give yourself a whole day to figure this out in advance. But if you're day trading, it'll take a little bit more practice to figure it out smoothly. But we have members who have been trading it for a week or two that have it down where they can intraday trade and they can know in a matter of seconds how many shares or lots they should be trading with. Remember, this automatically decides how many shares or lots to trade. This is the beauty of this. It takes the guesswork out. The specialist edge is by adding structure. The structure being the RPS method, you are taking the guesswork out of position sizing. Remember, we're an educational company. We want to educate you so that you don't have to guess, right? So you don't have to rely on an outside source and say, well, where would you put your stop? Call up a friend or call up another trader or ask some educator. Where do you don't want to rely on someone else. You want them to give you information so that you can come up with your own judgment and your own critique. But you don't want to say, well, he does it this way, so I guess I should do it that way. Remember, you're giving away your power, your trading power, if you do that. You want to empower yourself with getting a ton of information and then deciding for yourself what works best for you. Okay? So the specialist edge in this particular example is by adding structure, you're taking the guesswork out of your position sizing. And this goes into everything. It's not only money management, position sizing. It should be your strategy. It should be what market you trade. It should be what style you trade. You should never rely on someone else to tell you what to do. That's why we don't believe in trading rooms or chat rooms as specialist trading, because we don't want to use that as a crutch. So someone will say, well, Steve went long this, so I'll go long this. We want you to come up with your own decision. That's how we feel you ultimately become successful. When I was struggling on the floor of the exchange, I wanted to copy every trading signal that was generated by my mentors, and they wouldn't let me. They said, no, we'll give you the information, but you've got to decide what you're going to trade for yourself. And I got so frustrated. I said, why? Why can't I just piggyback what you're going to be doing? And they said, because you won't be learning. You'll be just copying us, and ultimately you'll continue to lose because you're going to try and trade like someone else, and that will only lead to disaster. You've got to come up with your own style, your own plan, by all the education we've been giving you, and that will get you on that road to consistency. And that's the same thing I teach to all of my students and all of our members. All right, so secret number 3 is never, ever use discretion when deciding your position size. You're not going to wake up one day and say, boy, I feel really lucky. I had a great trade yesterday. I'm going to bet the farm today. Or you're not going to say, boy, I've been doing fantastic, but I'm starting to get scared. I'll cut down on my position sizing because I'm just scared that I may lose it all. All right. These are all emotional decisions. All right. We want to take that emotion and that discretion out and that subjectivity and make it more mathematical. That's where the RPS method comes into play. Now, if we can just take a few moments here, I want to invite all of you to become members of our 7 Secrets of Money Management course. I just shared one of the secrets with you today. That's secret number 3. But here's what you receive in the course real quickly. Secret number 1, we tell you the true meaning of money management. And it's probably nothing that you think money management is. Most people think money management is stock placement and how many shares. These are all components or pieces of the puzzle, but it's not the true meaning. Secret number 2, we give you preliminary stops. We share all of our stops and all of our proprietary stop placement with you. Secret number 3, we go over the RPS method, which we just went over in detail. But the RPS method works differently for stocks and for the E-mini. So we share with you how it works in those markets as well. All right. Secret number 4, we talk about all our different trailing stops and different ways we use proprietary indicators to tell you how to use our trailing stops. Secrets 5 and 6 are advanced ways to implement risk-reward ratio and to increase your risk-reward ratio per trade. And lastly, secret number 7, I think, is the most important. In fact, in my opinion, this will pay for the course itself. It's ATM, or Advanced Trade Management. And what that is it's a technique designed to keep you out of a drawdown while you're currently trading the strategy. Now, we're not going to sit here and promise you that every strategy works 100% of the time. It's only natural for any strategy to go into some type of drawdown or a slump. So what the ATM does is it will keep you out of the market when your strategy is in a slump. Here's a perfect example of one of our students' equity curves trading the Forex markets. In fact, I believe this was just an equity curve in trading the euro dollar. And as you see, the strategy was working extremely well for the first part of this equity curve, but then look what happened. It gave everything back in a series of losses. What the ATM method does is it keeps you in only while your strategy is performing well. So this is a great technique. It's included, and it's probably saved me thousands, if not hundreds of thousands of dollars in my career while I was trading the markets, while I still continue to trade the markets. So this is all included. You get instant course access, detailed instruction, up to 8 videos, stop placement techniques, 6 techniques altogether, the RPS method for stocks, E-mini, and the Forex, risk-reward ratio, ATM, and access to my personal email. Now this, usually, all the things combined would cost you thousands of dollars, roughly around $24.95. We're reducing it for the FX Street members down to $18.71 with payment plans available. So if that's still too much for you, we offer payment plans so that you can pay this off and it'll meet your needs. But one more thing we include, a 30-minute phone consultation with myself so that you can talk to me over the phone. If there's anything you don't understand or anything you'd like to discuss, I can share my 37 years of trading experience with you. Okay? So I want to invite you all to become members. This is a great, great deal. A really discounted price. Remember, we have payment plans and we have discounts to work with you, okay? Plus the 30-minute phone consultation. For more information, you can go to our sister site, which is protraderstrategies.com. You can also go to the microsite on FX Street that FX Street has so kindly provided for us. I'm sorry I wasn't able to put the screenshot of it, but on the site, and I think they may have that for you. There is a link there where you'll get more information at FX Street along with discounts for any of our strategies or any of our courses. You can also contact us if you'd like to speak to us directly. Email us at bretm@specialisttrading.com or call us directly at area code 310-844-7220. Okay. I thank you for waiting. I'm going to take some questions if you happen to have them. Let me open up the question and answer box here. I see that I must have either explained everything perfectly or I scared everyone off because there are actually no questions at all. If you have any questions concerning anything I went over, please feel free to ask right now. Now's the time. Or once again, you can visit our sister site, which is protraderstrategies.com. That's where we sell and promote all of our individual strategies. You can get more information. Also, you can go to the microsite on FX Street that provides all of the information for us as well. Okay? But let me open up the question and answer box one last time just to see if there aren't. Remember, in closing here, if there are no questions, remember, we talked about secret number 3, which was mainly about position sizing, which was extremely important. But this transfers over into anything, even if we're talking about strategies, if we're talking about entry points, if we're talking about which markets to trade, or even if we're talking about what style to trade. Should we hold and become long-term traders, or should we just become intraday traders? You never want to take your information or signals from someone else. Okay? This will only lead you down a road of losses, in my opinion. And I know this firsthand because this is what I used to do. When I first started trading on the floor, we didn't have chat rooms and trading rooms then. We didn't even have the internet. But we used to have subscriptions and newsletters. And I would listen to all these guys and subscribe to them, and I would take all their signals of what they said to do. And at the end of the day, I had nothing to show for it. Some would work, some wouldn't. But over time, I would have accumulated a lot of losses. Okay? It wasn't until I started taking, all of my own knowledge and putting it together and keeping it simple and making a plan is when it started to become consistent. So if there's one thing we teach all of our members, it's that, listen, we're providing you with 37 years of experience that has stood the time that works, but we're putting it all together and we're holding your hand and constructing it so that it works for you. That's why we said we're an educational company. We're not just providing you with signals so that you blindly take them. Even though we have strategies, we have roughly upwards of 10 different Forex strategies. We want you to, empower yourself with the one that best meets your needs so that you can become successful. So we don't just simply give you signals and say, buy here, sell here. We want to give you the basic framework and the groundwork for these strategies, but then alter them a little bit so that you can make sure you understand it and it fits inside. Okay. Let me see if there are any, I see there are no questions in the chat box. So let me just start back. I don't really see any questions here. I don't know, Boyke, if you were asking a question or not, but I don't see any questions per se. No, I think that's really it. I'll give you one last time to ask questions or to point me in a direction, but other than that, I don't think we have anything, or I don't see anything in our chat box for any questions. So if you have any information, remember, FX has provided us with a microsite. It's on the site. You can check that out, and it'll give you a little bit more information about myself, about specialist trading, and about specific deals and specials that we have for the people who are attending our presentation. If you'd like to just find out basic information about all of our courses and strategies, please go to ProTraderStrategies.com. Contact one of our trading consultants, Brett M. at SpecialistTrading.com, or call us directly at area code 310-844-7220. All right, if there are no questions, I want to thank you all so much for attending. I give these presentations each and every month at FX Street. Been doing them for a number of years. I want to thank FX Street for inviting me to share my knowledge and to educate its subscribers. And I look forward to all of you becoming members of Specialist Trading and the 7 Secrets of Money Management course. Thank you so much. We'll see you next time. Bye-bye.